Imagine a guy in a tailored suit, carrying a clipboard, just walking into a heavily guarded, temperature-controlled vault.
Oh, wow. Sounds like a movie intro.
Right. But he isn't there to audit a central bank or some ancient national treasury. He is physically counting like 146 metric tons of gold bars.
Which is, what, over 700,000 troy ounces?
Yeah, exactly. And he's doing this just to prove that a digital cryptocurrency company actually has the money they claim to have.
It is the absolute definition of hard asset reality, just crashing headfirst into the digital finance world.
Welcome to another episode of the Token Trends Weekly Podcast. I'm Max Ledge.
And I'm Sasha Coin.
So when I first saw these audit numbers cross my desk, honestly, none of them made sense to me. You have Tether, right? The $184.6 billion stablecoin giant.
Yeah, the entity minting the digital dollars that essentially power the entire global crypto market.
Exactly. But suddenly, they're stockpiling physical gold and setting up these new corporate entities in El Salvador. So today, for our deep dive, we are looking at what is really going on here. Because it turns out they aren't just minting digital dollars anymore.
No, not at all. They are trying to orchestrate this massive fundamental pivot. We are looking at a transition from being just a pure stablecoin issuer to becoming a sovereign-level asset platform operator.
So we need to figure out what their actual endgame is for you guys listening. Because we're basically watching how a historic, completely unprecedented financial audit is serving as the launch pad for this incredibly ambitious tokenization platform.
Starting in Saudi Arabia, of all places.
Right. But let's begin with this audit, because the sheer scale of the numbers is just staggering. For years, the biggest question in crypto has always been, are these digital tokens actually backed one-to-one by real money?
Yeah, and historically, Tether relied on quarterly attestations to answer that. For anyone who might not live in the accounting world, an attestation is basically just a snapshot.
Like a financial selfie.
Exactly. An accounting firm comes in on a specific Tuesday, looks at the bank accounts, and says, yes, on this specific Tuesday, the money was there. But recently, they landed a landmark unqualified audit from KPMG US for their 2025 financials.
And unqualified means clean, right? No asterisks, no we think so, but clauses.
Right, a totally clean bill of health from a Big Four firm.
Yeah.
In this space, that is a massive flex. They are actually calling it the largest inaugural financial audit in history.
Wow. And an audit is an exhaustive forensic review of a whole year of operations. They look at risk controls, counterparties. Like I mentioned at the start, they actually counted the gold.
Yeah, they counted the physical gold. Plus, the audit showed that by the end of 2025, their reserves actually exceeded their liabilities by $6.814 billion.
That is an insane cushion.
It really is.
Yeah.
And by Q2 of 2026, their total group assets sat at an unbelievable $187.75 billion.
Okay, but the revenue engine behind that scale is what really reveals their broader strategy, I think.
Yeah.
Because they reported operating profits of $1.5 billion in a single quarter.
Yeah, and that profit isn't coming from crypto trading fees.
Right. It's heavily driven by traditional finance instruments, specifically U.S. Treasury bills and repurchase agreements, alongside this massive crypto war chest of 99,000 Bitcoin.
Which is a brilliant strategy.
It is. But let's pause on that terminology for a second just to make sure the mechanics are clear for everyone listening. Repurchase agreements, or repos, are basically super safe, short-term overnight loans.
Right.
You lend out cash, hold top-tier collateral like government bonds, and collect a small, extremely reliable interest payment. When you have tens of billions of dollars doing that every single night, it just prints money.
It creates a massive yield. And they've strategically structured all of this under an El Salvador-based entity, which is regulated by the country's digital asset regulator, the CNA.
That move to El Salvador feels very deliberate to me. I mean, they aren't trying to hold this massive physical war chest in a New York bank vault where it could be frozen by U.S. federal agencies.
Oh, absolutely not. They are positioning themselves in a sovereign jurisdiction that is aggressively friendly to digital assets. It gives them immense regulatory leverage.
And independence.
Exactly. It acts as the financial and legal bedrock they really need to launch their next phase, which is this project called Hadron.
Hadron by Tether. This is their new engine. It's a platform built to tokenize real-world assets. So we're talking stocks, bonds, commodities.
And they want to handle the entire life cycle, right?
Right.
From issuance all the way to KYC compliance.
Yeah. And KYC, or Know Your Customer, is the standard identity verification banks use to prevent money laundering. Hadron wants to handle all of that straight through to the lifecycle administration. But Honestly, I have to push back a bit here.
Go for it.
This is like a massive digital bank realizing their vault is completely full, right? So instead of just stacking more cash, they decide to start building and owning the actual highways that the money travels on.
That's a great way to put it.
But why? Why take on the massive headache of building global financial highways when you are already making $1 billion a quarter just sitting on the cash you have?
Well, it comes down to capturing real-world liquidity. Think about historically illiquid assets, commercial real estate, massive infrastructure projects, even fine art.
Oh, right. Because buying a commercial building today is it's like trying to send a massive video file over a 1990s dial-up modem.
Exactly. It takes months.
Yeah, you have armies of lawyers, escrows, title searches, intermediaries, and your capital is completely locked up and useless while you wait for the transaction to clear.
But Hadron wants to turn that commercial building into an email attachment you can send instantly. By using blockchain to digitize these illiquid assets into tokens, you make them globally tradable 24/7.
So Tether realizes that the next decade of finance isn't just about providing the digital currency to trade.
Right. It is about providing the underlying infrastructure for the actual assets to move on.
Okay, so they have the technology in this massive war chest to tokenize illiquid assets. But Wall Street is heavily guarded legacy territory. The big banks in New York and London aren't just going to hand over the keys to the kingdom to a crypto company.
Definitely not. So where do you even deploy a system like this to prove it actually works at scale?
You bypass Wall Street entirely.
Bingo. You go to a jurisdiction that is actively trying to build a new financial system from scratch. They went to the Middle East. They are deploying Hadron to tokenize institutional-grade real estate in Saudi Arabia.
Which explains the timing perfectly. Saudi Arabia is right in the middle of Vision 2030. This is their grand, state-sponsored strategy to modernize the entire economy and pivot away from oil dependence.
Yeah, they want to build a state-of-the-art, Sharia-compliant digital financial infrastructure.
And that Sharia-compliant aspect is really crucial, isn't it?
It is, because Islamic financial law prohibits traditional interest-based lending, basically what we call usury. It focuses instead on profit-sharing and asset-backed arrangements.
Oh, I see. So tokenizing physical real estate fits beautifully into that framework. Every digital token represents a tangible, physical piece of property rather than just some abstract debt obligation.
Exactly. And the numbers in the Saudi market are just huge. The real estate market there is valued at $79 billion in 2026, and it's projected to hit $114 billion by 2031.
Plus, they just enacted that new foreign ownership law in January 2026, right, that completely opens the floodgates to international capital.
It does. And to capture that massive market, Tether is using a very specific three-way partnership. It's basically a strategic triad. First, Tether provides the underlying Hadron technology. They supply the core code and the blockchain infrastructure.
They build the engine. Got it.
Second is a company called First Data, led by Chairman Nabil Al-Nuaim. They are the commercial lead. They actually issue the tokens and operate the primary market.
So they bring the go-to-market strategy and the local expertise.
Yeah, exactly.
So if Tether builds the engine, First Data is like the local dealership selling the cars to the market.
Yeah.
But who is building the roads?
What do you mean?
Well, who connects this futuristic crypto tech to the legacy banking systems that institutional buyers actually use? A Saudi sovereign wealth fund or a massive real estate trust isn't going to just download a basic crypto wallet on their phone to buy an office building.
Right. That falls to the third partner, BKN 301, led by CEO Stephen Muccioli. They handle the plumbing.
The plumbing, okay.
Yeah, they manage the integration, the banking connectivity, and the regulatory compliance. They ensure the tokens can seamlessly communicate with the existing fiat banking systems.
I do have to push back here, though. If Tether is this $180 billion behemoth, literally printing billions in pure profit every quarter, why are they sharing the pie at all?
That's a fair question.
Why rely on local partners like First Data and BKN 301? Why not just steamroll in, monopolize the whole process, and do everything themselves?
Because in the enterprise and sovereign level world, success does not depend on having the flashiest new blockchain code. It depends on boring reliability.
Boring reliability.
Yeah. Institutional investors demand proven infrastructure and flawless compliance before they commit billions of dollars to a new platform.
So boring reliability is the feature, not a bug.
It is the only way to operate at that scale. You cannot navigate the strict, highly nuanced requirements of sovereign-led capital markets as a foreign tech company. You need deeply integrated, regulated local partners managing the plumbing and those relationships.
Right. A foreign tech company moving fast and breaking things doesn't really work when you are dealing with the sovereign nation's real estate registry.
Exactly.
That makes total sense. You cannot beta test a national economy.
Yeah.
But this isn't stopping at just Saudi office buildings, is it? We're looking at a much wider horizon here.
Oh, absolutely. The tokenization of Saudi real estate is explicitly designed as a proof of concept. The framework they are building with First Data and BKN 301 is intended to expand to global energy markets and massive infrastructure project finance.
Wow, so they were going after the whole board.
We are talking about capturing a global prize here. Citi recently projected that the tokenized securities market could hit $5.5 trillion by the year 2030.
$5.5 trillion.
Yeah.
That is just a completely different stratosphere. But, as I am looking at all these moves, the physical gold, El Salvador, Hadron, Saudi Arabia, it really feels like there's a hidden motive here.
How so?
It feels deeply defensive to me.
Oh, it is absolutely a defensive necessity. Tether's traditional business model is under severe threat right now. Think about how they actually make their money. You give them a real dollar, they give you a digital USDT token.
Right.
Then they take your real dollar and invest it in treasury bills earning 5%. And they keep that 5% profit.
Which works beautifully when you have a monopoly.
But competitors are coming for that exact revenue stream. You have the OUSD consortium launching yield-bearing stablecoins. They're essentially trying to pass that reserve yield directly back to the token holders instead of keeping the profits.
So why would a user hold a Tether token that pays them nothing when they can hold a competitor's token that pays them 5%?
Exactly. The margin just gets competed away.
I see.
You also have Circle building out its Arc mainnet to capture more of the institutional market. And you have legacy payment giants making huge moves like that $1.8 billion MasterCard BVNK acquisition. They're trying to build their own global stablecoin rails.
So Tether looks around and realizes that to survive the next decade, they literally have to own the underlying rails, not just issue the currency that rides on them.
Yeah, it is an adapt or die scenario disguised as an ambitious expansion.
And the regulatory landscape is shifting aggressively against their old model, too. Like in July 2025, the U.S. passed the Genius Act.
Oh, the Genius Act is huge.
Yeah. It imposes incredibly strict new stablecoin rules with transition dates stretching out to 2028. It forces issuers to hold highly specific, regulated domestic assets if they want to operate in the American market.
Which essentially outlaws Tether's offshore flexible strategy for U.S. customers.
Right. Though Tether's trying to adapt to this by launching a new product called USAT with Anchorage Digital, built specifically to comply with the American market.
But that regulatory pressure is hitting them at a really vulnerable time, financially speaking.
Yes. I want to highlight something in their financial data that genuinely shocked me. If we look at the Q2 2026 BDO attestation, which is a separate financial review that came out after that big KPMG year-end audit, it highlighted a critical vulnerability.
You're talking about the excess reserve cushion.
Yes, the excess reserve cushion. Basically, the billions of dollars they hold over and above what they owe token holders. It actually halved in just 3 months.
That's a massive drop.
A drop from $8.23 billion in Q1 to $4.11 billion in Q2.
And when a company's core marketing relies heavily on the strength and invulnerability of its buffer, a 50% reduction in 1 quarter is a massive material event.
Think about the visceral stakes here. They just burned through half their safety net in 90 days, right? While they are parading around their biggest audit victory ever.
It completely changes the narrative.
It really does. This move into Saudi Arabia isn't just a fun side project or an R&D experiment. If their traditional stablecoin margins keep shrinking because of yield-bearing competitors and the Genius Act, this new Hadron platform has to work, or the whole $180 billion empire starts to crack.
It perfectly synthesizes the ultimate risk profile they're facing right now. Tether completely mastered the permissionless, fast-moving, crypto-native world. They won that game.
Yeah, hands down.
But now, as their core margins face pressure, they are gambling their future on navigating rigid, top-down, highly regulated, state-backed capital markets. It is an entirely different arena with a very different set of rules.
It really is the difference between building a highly successful software app in your garage and trying to build a physical national highway system. The rules of physics, politics, and finance are totally different.
Absolutely.
Which brings us to the end of our deep dives today. But before you guys go, I want to leave you with a final sort of mind-bending question to chew on.
Let's hear it.
Think about the long-term trajectory here. If a crypto-native stablecoin issuer successfully manages to become the underlying infrastructure for a sovereign nation's real estate and energy sectors, what happens to traditional national stock exchanges?
Oh, that is a fascinating paradigm shift. We could see a future where the legacy institutions we have relied on for centuries are eventually forced to rent their fundamental market infrastructure from crypto companies.
The disruptors literally become the landlords.
Exactly.
Well, thank you so much for joining us at the table today for this deep dive. If you enjoyed unpacking this massive shift in global finance with us, please make sure to subscribe to the Token Trends Weekly podcast wherever you are listening right now.
We love doing this research for you guys.
We really do. So the next time you see a jagged white line on an X-ray or a squeaky clean financial audit report, remember, in the world of global digital finance, the picture is rarely as simple as it seems. We will see you next week.